Good day, fellow investors. Interest rates.
Everything is off of interest rates.
Everything is off interest rates. Thanks, Warren. And the best topic for 2022 should be to really analyze the situation, the outlook, what is going on with interest rates, the impact that those have on our wealth, on our sensation of wealth, and there are some certainties that I think will give you value. Let's start discussing interest rates. The interest rates situation is the following. The current federal funds effective rate is 0. So, okay, now they said they will increase it, but it is still 0 with projections for 3 rate hikes in 2022. And we'll have to see how those projections impact the market. But over the last years, we have had practically all the time 0 interest rates, a little bit of a push higher, a test higher, but even before the current situation, those were already pushed lower because this was unsustainably high. Low interest rates are positive for a lot of things, starting from the government. If governments can borrow at 0, that is good for governments. 1 year US Treasury interest rate is 0.29. That's really low. Going towards 5 years, of course, historically it has been much higher. Now it is also higher from the bottoms, but we are still at low levels, 1.14. Perhaps this increase over the last year signals expectations that due to inflation, interest rates will be increased, and therefore always the market tries to anticipate what the Fed does, and as inflation is going higher, that's why you see already this increase in interest rates. And low interest rates that act like gravity on asset prices, as would Buffett say, allow for stocks to explode higher and yields to go lower. Everything is compared to interest rates, so if you have interest rates of 0.29, you compare that to the dividend yield of the S&P 500, which is 1.26, then you say, okay, this is so much better. This is actually 5 times better than the 1-year Treasury, and therefore one could say stocks are still ridiculously cheap. Of course, if interest rates change, then the valuations in the stock market might also change, but that's something we have to discuss a little bit deeper and assess the scenarios there. It's not that easy, as you will see. Many say, okay, interest rates up 50%, 80%, crash, stock market crash, disaster, but it's not that straightforward. If you compare the treasury yield and the dividend yield, you can see that there was some correlation, but not really perfect correlation. 80s, 90s, okay, as the treasury yield went down, so did the expected dividend yield. Companies are paying less dividends, but companies are also borrowing more money and paying less in cost, which allows for higher earnings. And we still see some spread here, but the spread is much smaller than it was when yields were much higher. So the situation is still at 0 interest rates, but we have already seen some hikes in the UK, and the Fed announced tapering, double tapering, whatever, and interest rate hikes to slow down a little bit the overheating inflationary economy. UK has already acted, and the plan is for 3 rate hikes in 2022. If we look at the Fed's dot plot, so what are their projections for hikes? 0 in 2021, and we see the average projections, 3 of these members will be replaced, so we'll see what Biden has to say about it, but we see interest rates likely at the end of 2022 at 0.75. Treasuries have already priced that in likely, and projections are for 2023 to go even higher, next again higher to something that we have seen in 2019 that didn't work. Of course, this depends on what happens, and we'll see what will happen. Impossible to predict. And this impossible to predict fact is very important. We always discuss the Fed, this, Jerome Powell, that, left and right. But actually, I wouldn't want to be in his shoes. It's an impossible job. You will fail 100%. You can do some good short-term, long-term, but economics is not something that you can do miracles with monetary policy. It is about productivity, education, and those things. And with monetary policy, you can just delay things or keep them stable for a while. So it's an impossible job. We have to give credit to central bankers there. Plus, every word they say is priced in by the market, affects then their thinking, so there is so much reflexivity. And they said inflation is transitory, kept rates at zero, inflation isn't transitory, so now they have to change. Even they can't predict what will happen, so that's the impossibility of their job. And talking about inflation, which is the driver of increased interest rates, so 2-decade high inflation becomes 40-year high in inflation. That is really, really something extraordinary. 7% inflation. Also, if we look at the European Central Bank, look at their projections. Their projections for inflation were 2.5%. Inflation is already sky higher. So these projections are futile there. They even expect below 2% long-term inflation. Nobody knows. This is really not predictable, and this is just something they have to say to keep the markets at bay. Nothing of predictable power here. And they say also, like the Fed, they will start with tapering, lower the regular bond buying, thus less liquidity, to ease up on inflation a little bit. But let's talk about scenarios. I'll make a special video for next week how these interest rates and other things might impact all asset classes, from gold, from crypto, stocks, bonds, real estate, land, commodities, whatever. So I'll see you next week for that video. But let's focus on interest rates now and on possible scenarios. The first scenario is, okay, everything goes as planned, we increase interest rates, economy still strong, no impact on spending, no impact on investments, no impact on employment, unemployment, everything goes well, everybody happy, the world doesn't have a shock, external shocks. This is what is then priced in, this is what is planned, this is what is linear. If all goes as planned, it might go as planned, it might not. I think the last 2 years really show how unpredictable life, the world, and everything is. When it comes to inflation, you can make your projections, but then there is 7.5 billion people in the world, a lot of new people to the middle class coming in the next 5-10 years, a lot of spending, a lot of competing for all those resources that are now global, and you can't plan that in from your local country perspective. There are so many factors these days that the correct answer is that nobody knows what will happen. Therefore, we have to be prepared for anything. So option 1, all goes well. We have option 2. We have to look then at debt, the cost of doing business, the cost of debt, spending, housing, stocks, inflation, and that's what we're going to do, just to show you the unpredictability of it all. What would higher interest rates do to debt? Because there is debt. At least the last time I looked. Also, debt is compared to assets, but assets are financial assets. So if we look at consumer finances and look at net worth, America, Europe, same thing, that 43% of assets are financial assets. Stock market, stocks. So all this depends on the market. Pension funds, bonds, high dependence on the market and interest rates. Real estate also highly dependent on mortgage rates, interest rates. So total assets, yes, 160 trillion, but how much of this depends or is the result of low interest rates? Well, if we look at net worth over the last 14-15 years, it has more than doubled, and it has more than doubled just because interest rates went to zero. So if interest rates go higher, then this net income peak might go lower, like it was the case in 2009, and we all remember the fun we had in these years. Because the net worth, especially in this financial engineered world, impacts your spending, we all feel extremely rich now. But is that real wealth or not? That is something that we'll get the answer over the next decades as we compete in a global world. And if interest rates go higher, it will impact a lot of things, especially those that have high debt. If we look at the federal budget, they are borrowing because there is a lot of liquidity, and they will keep borrowing year after year, especially if things don't go as planned, and higher interest rates might impact that a little bit. However, if we look at the spending, net interest costs is 300 billion per year, but let's check interest rates on average debt. I think it's a little bit lower than 10-year, but okay, 1.4%, which leads to 305 billion in cost. If interest rates go higher, these interest costs go higher. 28 trillion in debt, which will likely be even more and more and more. If interest rates go to 4.5 or even higher, this is 4 times current interest rates, then these 305 billion become 1.2 trillion, which is 20% of the total budget. So higher interest rates would destroy the federal budget in the US, would destroy the European budget, so interest costs would be equal to social security costs. That is something insane, and that is something which makes you think about the possibility of higher interest rates. If we look at this dot plot, up to 2.5% long term, and that's it. That's the Fed's maximum hoped target, because that they know that maybe they will reach 1.75, 1.5, maybe 2019 it reached, and then they lowered it immediately. So at 0.5, 0.75, it still can be lived, but at one point higher interest rates really start impacting the complete financially engineered structure of everything we live in that makes us feel so rich. And therefore, we have to assess or implement the impossibility of higher rates in the future, allowing for higher inflation that can be the savior, because if you are in a lot of debt, if you let inflation run, the value of that debt in real terms becomes much lower, easier to service. So that's the game. Thus, the conclusion is governments, European, US, will, as always in history, burn the value of the currency by indebting, by printing, by keeping interest low, and sacrifice a lot of things there to keep the perception of things like those are. The thing is that you have money now, stocks are going up, real estate, everyone is feeling rich, spending, but that's just a perception because your purchasing power is going down. And you can't, as a human, balance those things, which the Fed takes advantage of. Interest rates in Europe, and that's why always Europe is lagging compared to the Fed, can't go up. This whole scheme of things would get crushed, so it would be a disaster, even more than in US, because the US is still the reserve currency of the world. Also, corporate debt impacts earnings, impacts spending, company investing, stock markets. If we look at the corporate debt, it doubled over the last 10 years. Doubled. So, double the debt. If interest rates go to 4.5%, so triple for companies, it means that the cost of their debt will triple interest rates, double compared to 2009. When we had the financial crisis, lo and behold, that's a 6x increase in cost of debt. That's something that doesn't really allow playing the same games that the Fed used to play in history. So if we look at the reactions to overheating economies going from 3% to 5, 6%, from 0, 1, trying to stop things to 4, 5, and they tried it here and it failed already before 2020. They were already lowering. January, it was already 1 percentage point lower. Before January, nobody knew what will happen, and then to 0. So to keep this wealth, this perception of wealth, it's very unlikely that interest rates will go significantly higher. And interest rates would also impact consumption, government spending if you have to pay debt. So this is a situation that is really, really tough and will be really, really tough to handle. And especially, you can't counter inflation depending on where inflation is, how it's coming. Inflation can be global. You will try to use measures that will act locally. Very, very, very difficult ahead. My forecast is that things will surely be volatile ahead. We can have the stock market double, as those are businesses. You prefer to own businesses that do good, especially in an environment where there is plenty of money, inflationary environment. So stocks can double, but if there is a contraction, the Fed will do anything to prevent that, depending on when they lose control about things. They are on a slippery, slippery slope, but for now, all things look still rich for us all. The key is that real returns will be very low, because now, with inflation at 6%, to get to real returns, you need to a return of 10% to get real returns. And compared to what the bank offers, dividends, it's very, very hard to get to those returns. So long-term real returns are destined to be low. And the faking, this perception of we are rich, but we are taking so much debt to keep things as is, to keep us feeling, oh, we are so rich, we are spending money, here $1 billion, here $1 trillion, who cares, there is so much money. That will be very, very costly, because if we look at pension funds that are invested in bonds, then okay, there goes your pension, there goes your real purchasing power. And sooner or later, the costs of what we are doing now will emerge. If we look at, I found this not scientific, but this is what real life is. And if we look at 2020, 2021, this is more than 10% increase in a shopping basket plus a gallon of gas. That is huge. This means that the purchasing power for these things, potato, has gone down 10%. That is a lot. In Europe also, so if you're trying to build a house, you are destroyed, or buy a house. Just read that in the Netherlands, home prices in 12 months went up 20%. So, okay, those that have a home feel richer, but that's just a perception of richness. Those who want to buy a home, those are screwed. If you look at Los Angeles, for example, so 2 years ago, 282 was the home price index, and now it is 360. That's what, 30% in 2-3 years. That is insane. And measures of inflation are measured globally. Of course, real estate in the middle of nowhere don't go up, but those impact the calculations. So those calculations are for little kids. Pension funds own bonds.
You know, if you tell me that I'm going to have to lend money to the government minus 2% a year, and I'm talking nominal figures, not you know, you're just telling me how I'll go broke over time. if I do that, so it pushes you to do other things. And of course, we've seen it. Well, we saw the rest of the world do it in even more extreme fashion. But nobody, Paul Samuelson, brilliant man. Nobody thought you could do this, and we don't really know what the consequences are. But we know there are consequences, obviously.
And yes, if you own something with a negative real return, you'll end up broke. So that's the cost that is created. They are sacrificing the purchasing power, the currencies, all those things that you don't feel it burning a hole in your pocket, those are all being sacrificed because nobody talks about that. Now, how to invest? Well, investing is always about risk and reward. We have to take advantage of the flood of money, so we have to be invested in stocks, but we have to also understand the risks and long-term reward. Ray Dalio said diversification globally, that is something to think about. I think I'm well diversified across my 5 investments with currencies, so global investments. So we will see what will happen. I wish I had the simple answer that I said, do this, do this, do this, Merry Christmas, have a Happy New Year, and you will be fine. The world is getting much more sophisticated than that, and each one of us has to see, okay, how can I structure my holdings so that I am protecting my purchasing power, making more than the destruction of it, and doing good long term no matter what happens. For me, it's always about mindset, so over time it's a long-term process. Nothing will happen next year, hopefully, but these things will impact finances and everything over the next 10 years, and therefore it's important to start positioning yourself, thinking about these risks and rewards, and that's what we do on this channel. And I'll do a next video, asset classes, really discuss 10 asset classes, the risk and reward compared to price, which will give more indications on the mindset thing. To conclude, we have interest rates that can't really go up, so those 50, 70, 80% crashes are very, very unlikely. If those happen, we will be thinking what to eat. Nobody will care more about stock market virtual portfolios, so very unlikely. Hope it doesn't happen. Therefore, we have to see how to navigate these things, how to position ourselves to take advantage a little bit of the craziness that's going on. Some go to cryptocurrencies, but don't consider the risks there, and you see those things exploding. That's also something we'll talk about in the asset classes. For me, it's always about balancing value, trying to collect as much long-term value no matter what comes in the currency environment, monetary environment. Just focus on those businesses, own those businesses that will likely do good no matter what. That's the best I can do. Then there is the market and everything, but that is unpredictable. Interest rates unpredictable. Focus on what is predictable. This is what we do here. Thanks for watching. See you in the next video.